the Financial Survival Network. Now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, what can you say about this economy? The markets seem to be on a bounce, and yet layoffs are plentiful. Here to opine about this is our good friend, Michael Pento, Pento Portfolio Strategies, and pentoport.com. Michael, it's great to have you back on, and happy and healthy to you and yours for the coming year. I wish we could say that for everyone, but with all these layoffs, I mean, it's like everybody's laying off. Even if you weren't thinking about laying off after hearing all the layoffs, figure why not? Hey, how bad can it get?
Well, happy New Year to you. Thanks for having me on the program. You know, I heard I was watching the Fast Money crowd last night on CNBC, and I was watching it with my wife, and I had the host say, she was mentioning the plethora, one of the plethora of companies that is laying off, and she said, "But that's good news. That's good news for the stock." You know, it's revolting. You know, it's not good. You know, is it good news also, Melissa? Is if a company's hiring, is that good news? So if a company's hiring, it's great news because they're growing, right? And if they're laying off, it's wonderful because they're reducing headcount and that's lowering expenses. It's actually nauseating, if you ask me. Everything's Kerry. Everything is good. You know, the Fed is going to cut rates because we have disinflation. That's good news. But today we have GDP coming in at 2.9% for Q4, and that means the Fed's going to keep raising rates. But that's good news because we have growth. I mean, everything is good news. You know, here's what's bad news, Kerry. Though, M2 money supply is shrinking. The Fed is still doing QT. The Fed has raised rates at the fastest rate of change in history, from 0 to 5% by March. Is where they'll be. Those are some of the things that you have to think about, other than just forgetting about the fact that we've been in a bear market since January. We've had a slight bounce here in the start of the new year, mostly probably related to tax loss selling late in 22 and then rebuying those things 30 days later to avoid the wash sale. But this is not the beginning of a bull market, nor is it the beginning of some massive shift higher in global economic growth.
All right. So obviously, it appears that if we're not in a recession already, if we haven't even been in one for at least 3 or 4 quarters, when you factor in these outrageous inflation numbers, it sure looks like we're headed for one. And even if it gets disguised by the inflation, because you're spending so much more on gasoline and food, even if it's disguised, it's stagflationary, which is kind of, it appears that there's growth, but that's all a question of inflation numbers kicking up the actual sales numbers, the actual GDP. But when you don't properly account for inflation, which we haven't done for in a generation, real economic growth is shrinking while the GDP is going up.
You're 100% correct. If you actually measured the inflation that we had accurately, it's 20%. So unless nominal GDP is up by 20% year over year, which it is not, you have real GDP falling. And perhaps that, you look at the soft data and the hard data. So there was a very recent survey coming out interviewing a bunch of Americans about how they feel their status of life right now. And the survey came out with this conclusion, which actually shocked me. 74% of Americans right now are living paycheck to paycheck. Almost 3/4 of Americans. So if you look at maybe it's the top quartile that's doing well, and people like you and I maybe, but the bottom 3 quartiles are living paycheck to paycheck. They don't have $400 in case of an emergency. That was the question. For $400 puts these people into a condition of insolvency. I think it was 64% of those people, somewhere in the 60, 65%. don't even have $400 in savings, and 3/4 are living just paycheck to paycheck. That's very, very, very sad. So when you talk about, when people talk about how wonderful it is that people are getting laid off, can I just, because I'm getting old now, I'm almost 60 years old. I'm gonna read to you because I can't remember 15 numbers. This is the recent spate of layoffs, just very recently over the past week. Manufacturing giant 3M cut 2,500 jobs. Bank of America freezed hiring. Microsoft is laying off 10%. 10,000 people, 5% of the workforce. Amazon cuts headcount by 18,000. Google shedding 6,000 employees. 6% of employees, 12,000 people, excuse me. Wayfair cutting 10% of workforce. Meta, Facebook, Meta, whatever the hell they're calling themselves now, 11,000 jobs. Salesforce, 10% of the workforce. Spotify cutting 6%. IBM shedding 3,900 people. SAP cutting jobs. Dow Inc. cutting jobs. Tech cuts in Q4 were 80,000 people were net let go, which is double the amount of Q3. And yet we have the Bureau of Labor Statistics this morning, Kerry, coming out with a forever better figure of initial jobless claims, 189,000 people. Oh, better than expected. There's supposed to be 200,000 people let go. There's only 189. So my question is, well, is this just something that's going to hit the market in, when these people exhaust their severance package, and then they're going to file unemployment all at once in like May? I don't know. But this is very scary what I see going on in the economy. And the fact that we have the stock market totally disjointed from reality. We're now at 158% total market cap of equities to GDP. Price to sales. When I just say price to sales and total market cap of GDP, those are the two most important metrics. Because you can't manipulate sales. And the valuation of the market compared to the underlying economy is the best metric that out there. Even Warren Buffett agrees with that one. It's his those two figures I just mentioned are at all-time record highs for any period of time since the beginning of the signing of the Buttonwood Agreement, which created the New York Stock Exchange, all the way through to the end of the pandemic era, which is 2020. In the wake of the pandemic era, and when we had $6 trillion of quantitative easing and $4.5 trillion of helicopter money. That's how expensive the market is right now. And when you think about that in context of the fact that we have earnings growth that are going to plummet, the average earnings decline in the last 10 recessions has been 30%. 30%. So you're looking at a stock market, the S&P 500 should be, it's right now $220 in earnings for 2022. 2023 earnings should plunge to $158. So I think we're trading at like 26 times. So we're trading at 26 times forward earnings. The average is 17.2. Why would we be trading at such a huge premium when we're actually going to be entering into an official recession very shortly, if we're not in one already? Look at the ISMs. I'll talk about that in a second. And earnings growth is falling.
Hey, so Tesla had record earnings.
Yeah. Yeah. And Elon Musk says he's going to could make 2 million cars next year.
I don't know who's going to buy them.
I mean, yeah. Listen, if you're gonna listen and hang your investment advice on every word that comes on Elon Musk, you're gonna have a problem. All right.
So you'd be buying shares in Twitter, but wait, you can't buy shares in Twitter. He owns it.
Yeah. He's perpetually bullish and overly optimistic, and unfortunately disappoints the market many, many times with its predictions. So
yeah.
Well. I will instead look at the liquidity cycle. I'm going to look at the rate of change of money supply growth, and I'm going to look at the number of banks. 40% of banks are now tightening lending standards. So if you measure and map the liquidity cycle, you're going to be far better off than these perma-bull carnival barkers that appear in the mainstream financial media.
So is it the time to go short now? I mean, you've been around the market a long, long time. not that long because you're a young guy, but for decades. And what about the January effect? So goes January, so goes the market.
Well, if you listen to Tom Lee, he says, the first 4 days, first 4 trading days of January were up. So that means we're going to be up 20% for the year. This is the kind of useless BS that you get from the talking heads. So I've been in the business for 32 years. All right. I'm almost 60 years old, as I said. So I understand what you really should be looking at when it comes to avoiding the downfalls of 50% retracements in your pile of equity, in your capital, your retirement fund. Recessions are one of those things you have to avoid being grossly net long high beta stocks. Now, I said in December of 21 that 22 was going to be a very challenging year. And thank God, me and my clients avoided the vast majority of that carnage last year. Where the S&P was down 20%, the Nasdaq's down 30%, bonds, long-term bonds lost 30%. There was no place to hide. Not even gold was an offset.
What were
What
your numbers look like for the year?
Less than 4% down, like 3.
Which is like, hey, you broke even.
Yeah.
4%'s the tip now.
First losing year.
Restaurant.
First losing year in 7 years. But it was my model, the inflation, deflation, economic cycle model, that kept me on the right side of the trade. Now this year, my model was improving, and I have to admit, this year my clients will vouch for this. We actually sold one. We had 2 long positions, 5%, 5% was each the weighting. We sold one, replaced it with another. I'm sorry, did I say long? We had 2 short positions, 5% in one, 5% the other. We still have one, cashed out on the other one with a nice profit. We replaced that weighting with another short that is less geared towards a straight short in a type 3 margin account. We also took some longs on in the portfolio because the model is a timing tool. It doesn't tell you what's going to happen in a day or in a week, but it tells you what the cycle's doing. And the economic cycle was getting better. In other words, there has been a loosening of financial conditions. For example, if you look at high yield to treasury spreads, they're actually contracting and have been so for the past couple of months. So, I mean, I can't ignore that as a trader, but what I still want you to understand, and I want to make sure your audience gets, I want to leave you with this point, drill it home. Bear markets are not linear. There are many bear market bounces. Okay. In the course of a bear market. And bear markets usually run around 2 or 3 years, true, genuine bear markets. And we still have about another 2 years left in this one, year or 2 left in this one. If you look at the inexorable trends of fiscal and monetary policies that are still tightening outside of China, ex-China, ex-Japan, we are still going to have a brutal recession. Earnings are going to come down at least 30%. Fair value for the S&P 500 is somewhere around 2,700. We're at 4,000, above 4,000 today. So there's a lot of pain left, but the model helps me get the timing right, when to press my shorts and when to get a little less defensive.
Mm-hmm. All right. So looking at it, we need to be short this market for the rest of the year. Like you say, it's not linear, but the trend line is down for sure.
Trend line is down. What you're looking at in this January so far is 2 things, in my opinion. Number one, we pulled forward the reopening of China. Now, China's debt to GDP was 143% in 2006, just prior to the global financial crisis. China helped pull the global economy out of a recession by a massive re-leveraging of the entire economy. They took their debt all the way up, this according to the Bank of International Settlements, above 300% total debt to GDP. So from 146 above 300. Okay, that's a doubling of the debt to GDP, not a doubling of the debt. The debt went from something like 2 trillion to 20 something trillion. But I'm looking at just the debt to GDP ratio. That's a double. They cannot do what they once did in 2008, which was pull the economy out of a global recession. And if you look at the United States total debt to GDP is also above 300% right now, but it was in the 240s prior to the Great Recession. But Kerry, even our debt to GDP situation, our debt is a little bit better than China at this moment, perhaps. You can't say that the United States right now could launch some massive fiscal policy. I mean, you should imagine what would happen if the Treasury Secretary Yellen, along with Uncle Joe Biden over there, said, who by the way is a neocon and a socialist, the way he's acting. It's just disgusting, but I don't want to get into politics. Imagine if Yellen said, we're now going to launch a multi-trillion-dollar fiscal stimulus package now, which will be monetized by the Federal Reserve. Would you rather to pontificate on what happened with yields and the dollar and inflation at that juncture if the U.S. tried that now? I mean, you're talking about a crash of the currency. You're talking about skyrocketing yields and inflation that would run amok, inexorably high inflation, intractable inflation. So if we can't do it here, how can China do it? So that's one thing that's helping the reopening of China. It's going to be a truncated and I think a anemic help to the global economy. And then also you have these delayed lagged effects of the monetary policies. And don't forget, March of 22, less than a year ago, we were still at 0 Fed funds rate, 0.
Mm-hmm.
We will be 5. And if monetary tightening has about a 12-month lag to it, then we should really start to feel the effects of all this tightening sometime around the summer, sometime around June or July, when we're actually also going to be hit with this debt ceiling debacle. Now, I know they're going to raise the debt ceiling. I feel very confident about that. They always do. They always find a way to do it. They've done it like 60-something times since the 1960s. Democrats and Republicans always find a way to raise the debt ceiling. But they'll probably do it with some kind of what I feel will be all of the Democrats, 212 Democrats will raise the debt ceiling. Of course, they don't have any objection to that. Both parties just go along with whoever is in power.
Of course.
Path of least resistance. And then I guess Speaker McCarthy will come up with a handful of Republicans to get him to 218. And they'll agree to say, oh, we'll cut spending in the future. Don't worry about it. We've agreed. We really fought hard and we're going to cut spending in the future, which those things never happen, right? And the Democrats will say, hey, it was a clean debt ceiling raise. And then we'll go on our merry way. But debt ceiling chaos debates, just like 2011 when the United States debt was downgraded, have always been bullish for bond prices, yields go lower, and very bearish for stocks.
All right. Well, I guess that's where we're heading here, huh? I mean, what are we going to do, right?
Well, that's not much you could do. I'm going to talk about the Fed right now. Now, so the Federal Reserve right now, Wall Street wants you to believe that a Federal Reserve that stops hiking interest rates is now bullish, just like the Bank of Canada just did. They said Bank of Canada went to 4.5%. They said we're not going to raise rates anymore. Well, the Bank of Canada has a totally different characteristics to fight. They have a mortgage problem there. Many more of their mortgages are fixed rate. They have a bigger problem with debt and mortgages. But even if the Fed, Kerry, even if the Fed stopped hiking rates at say 5% come March, don't forget about the lag effects I just mentioned, but also markets don't tend to bottom when the Fed stops hiking rates. So the Fed started cutting rates in September of 2007. And 2 years later, we were down 50% on the S&P 500. The Fed started to cut rates in January of 2001. 2 years later, we were down 50% on the S&P 500. So I would be very hesitant to go, massively long the stock market just because the Fed stops, not cut rates, stops hiking rates. Big mistake.
You have any thoughts as far as the Ukraine war effects on the global economy, U.S., and what the Fed is going to be constrained to do?
Well, my visceral reaction is one of disgust. I mean, we should be doing our best to be making peace in Ukraine and
Yeah,
Ukraine and Russia. I mean, in my opinion, I know it's controversial, but sending Abrams tanks to Ukraine and doing everything we can. Biden wants to do everything he can to support Ukraine. Well, I mean, Ukraine used to be part of Russia, and certainly the eastern part of Ukraine, the Donbass region, used to be part of Russia. Those people mostly
yeah.
speak Russian. They feel more allied, allied to Russia. So, I'm all about peace. So let's just try to get a deal brokered, Mr. Biden, between um, Ukraine and Russia, Putin and Zelensky.
Sounds reasonable to me.
You take the Donbass region. We'll draw a line in the sand there. The rest of Ukraine joins NATO, and maybe that's a deal that can be done. And then we don't have to have any of this, multi-year bloodshed and destruction,
Yeah,
and the loss of human life and happiness for
for
year
nothing.
year after year. For what?
For
What are we going to
nothing.
gain? But I'll tell you what scares me though, Kerry, is Biden's now sending, along with Germany, sending heavy duty tanks to Ukraine. They need. We're not sending troops yet, but they do need U.S. troops to train them on these tanks. I'm quite sure they have no idea how to operate these tanks, so there'll be U.S. troops on the ground
Yeah,
there.
they're not easy. So they'll have contractors
Yeah,
running the mercenaries,
right,
former U.S. Military guys.
right.
Will
But
they
that
be
doesn't
paying
fool.
$1,000 or $5,000 a week to
And
run
that
these
doesn't
tanks? That's
that
what
doesn't
it's
fool
about.
Putin. I mean, that doesn't fool Putin. Putin said this is a red line that we have crossed. And I'm sure that we wouldn't have appreciated very much if in the Iraq war, Russia was overtly arming the Iraqi army. My point here is that we do risk at least the chances of a tactical nuclear weapon being deployed if you push Putin too hard. That the chances of that have increased. So it's not very good. Stock market doesn't seem to care about it. But, it's wonderful news for the neocons in DC. We get a lot more money for the
Hey,
for
it's
the
all about
military.
the money. Look at the money going into the military-industrial complex as a result of this war. I mean, they love it. It's these defense contractors are like the Pfizers of national defense, right?
Well, it's just sad that the Republicans and Democrats can't agree on anything: fiscal policy, monetary policy, abortion, death penalty. You name an issue, and there's like polar opposites. They absolutely can't agree on anything. But what's the one thing that they come together on? The war.
Ukraine. Yeah,
War is
they love war.
war is wonderful. I mean, a Democrat was in the White House in World War II. Democrat was in the White House in the start of the Vietnam War. We have a Democrat now who's in charge of the White House, who absolutely loves Ukraine above all. He will risk World War III to defend the. In fact, I didn't even hear him say anything about Crimea. Is he going to now try to annex Crimea back to Ukraine? Is that what? That's never going to happen. I don't think Putin will ever let that happen. So,
No.
and again, I would like us to seek peace before war, be a conduit for peace rather than one to exacerbate conflagration. And it's also very costly. I mean, we're looking at defense spending.
Inflationary.
It's highly it's a big drain on other resources we actually need to deploy in this country. Say again, I'm sorry.
At a time we can least afford it.
Yeah, exactly. $32 trillion in debt. a debt to GDP ratio is higher than any other time in this country's history outside of the very end of World War II. And it's going a lot higher from here with the unfunded liabilities coming on strong. So we need to be investing appropriately, cutting taxes, reducing spending, and having a real economy. Kerry, we don't have a real economy. Economy is completely artificial, and it's still reliant on these triumvirate of bubbles: the bond market, stock market, and the real estate market.
I don't know, man. It's a crazy world out there. Hey, but those unfunded liabilities you're talking about, that's my Medicare and Social Security. Don't touch that.
No, they won't touch that. Ask Paul Ryan if they'll touch that. They could at least do something. They could raise the cap when you stop paying into it. Why don't you raise that? That's something I think everybody could agree on.
Hey, everybody pays in 10% more. We'll get another few years out of this Ponzi till they'll kick the can down the road. They got to do something. And, it's people don't even notice they're withholding tax, right? I mean, they just know the gross amount of their paycheck. So everybody chips in $100 a month more, and it'll keep the Ponzi going for a while. I was just having a long talk with my buddies at Starbucks. Have a group of friends that I've met, when I moved down to Florida, and we were talking about Madoff. There's some special on TV, and his was a $60 billion fraud, 20 billion actually put in, but the fraud taking place at the highest levels of our government makes Bernie look like a piker.
Yeah, one good thing I love these debt ceiling debates because can't default on our obligations. Well, yes, Congress passes bills and into law that increase spending, and we should honor those obligations. So that's what the one side of the aisle says. But the other side of the aisle, we have this debt ceiling debate. These 20 Republicans that are like Tea Party Republicans who I'm a libertarian. I'm not a Democrat or a Republican.
Same here, man.
Thank goodness. So but they're saying, wait a second, what about the other thing that we passed into law, which is called a debt ceiling? That matters too. They both matter. So let's agree on cutting spending and living within our means. I mean, what other entity on this planet, corporation, family, you name it, doesn't have to live?
My ex-wife, she could give the Democrats a run for it, or the Congress. But I was the debt ceiling.
Yeah, but you don't have a printing press. That's the problem. You don't have a printing press. I mean, if we all had a printing press like the government does, and that's where this is all heading to. I model these cycles of disinflation, deflation, stagflation, intractable inflation. We're eventually headed towards intractable inflation. Don't get me wrong. We are now in a disinflation headed towards a deflationary cycle. But the secular trend is one of helicopter money and debt monetization. This is the only way this Ponzi scheme works.
Let's talk about that.
It's either that or have a real economy. You want to have a real economy? Let's have a deflationary depression that would make the 1930s look like a Sunday picnic. That's what would happen. I mean, if you really want home prices to come down to a level that's supported by the free market, you'd wipe out the banking system. Leverage loans would say, I'm sorry?
I say there'd be no debt because all of our high prices of healthcare, college, cars, and housing all revolves around the fact of easy money, and that you don't have to worry that the price is going high because you can borrow it, right? So it's all easy money. It's all credit creation. But let's talk about this inflationary cycle. It's a little too premature to break out the champagne bottles and say inflation has been defeated just because some prices are declining across the economy. You're old enough to remember, we both remember the last inflationary cycle took 25 years to work its way through. It never actually ended. It just became, through hedonics and everything else, harder to actually see. And 5%, 3 to 5% inflation is a lot more acceptable than 10 to 15, right?
But
But
it's less noticeable, correct?
yeah, so what we're seeing right now, this decline in inflation, the uh, death of inflation has been greatly exaggerated here, hasn't it?
Well, from 9.1% to 6.5%, I guess you can't really pop champagne corks over the CPI disinflating, the rate of change or the rate of change coming down. But again, 6.5%, when most people aren't getting that raise. And if you look at if you know, replay what I just started the interview with all those people getting laid off, they're not getting any increase at all, they're getting a decrease. So their real wages are plunging or are about to plunge. So yeah, look at the price of energy. So this is what gets me. So one of my problems I have with this recent rally, and then I know it won't last. Let's just say this rally is sustainable, and the Fed is about to stop hiking rates. Well, look what's been happening to the U.S. dollar of late. It's been losing a lot of ground. All right, I think it's down like 11% since in the last couple of quarters. Maybe even a little bit more than that. Look at energy prices. Look at West Texas Intermediate crude surging in the last couple of weeks.
$81. Yeah.
Last couple of weeks. So if you have a genuine Fed pivot now below 1970s, we tried this already. Like when you're fighting inflation, and I think Powell understands this, Kerry. When you're fighting inflation, you have to kill it. Like in the Romans, like destroying, the Carthaginians.
Carthaginians. Yeah.
Carthaginians, thank you. And then, plowing salt into the dirt. You got to kill it. You got to end it.
Yeah.
And you can't end it by, kind of like, mamby-pammying around the edges. You have to kill it. And 6.5% does not kill inflation. They're going to have to take interest rates to 5% or at a minimum, keep them there for a very long time and continue, most importantly, Kerry, continue on with quantitative tightening. There's not much talk about that. I don't understand why we're trying to kill Main Street more than we're trying to kill Wall Street. Well, maybe I do. Maybe because private equity
the way
power.
It works. It's always
private equity. Yeah. If you're really genuine, listen, I'm old school. Listen, I know what causes inflation. I'll tell you the truth. It's not a wage price spiral. And that doesn't cause inflation. It's when you monetize debt and send the money directly to people. That's what caused inflation. It's called helicopter money. We tried it. It worked beautifully. Like it has
the monetary phenomena.
Every other single
first
time.
And foremost, right?
And if you want to genuinely fight inflation, then take that damn monetary base that you took from 4.5 trillion to 9 trillion in 2 years. Take it back down to 4.5 trillion or close to it. Not it right now. We're still above 8 trillion, well above 8 trillion. So, Mr. Powell, if you're listening to Kerry Lutz, and this is
no one listens.
survival.
Hey, no one listens to me, Michael. You know that.
But if anybody listening to me can get him to listen to what I'm about to say, if you really want to tackle inflation, if you're genuinely interested in tackling inflation, you got to kill the Wall Street monster. And to do that, you have to kill the reckless speculation with banks and financial institutions. So take down your monetary base more aggressively, because a lot of that right now is being offset by what Janet Yellen's doing right now. Those special things that she does to keep the Treasury afloat. Well, right now she's taking the Treasury account, the money that the Fed has. The Treasury has parked at the Fed, and that's it's like capital stock. It takes it out of the Treasury and then puts it into the economy. So that's what's happening now. It's offsetting the QT,
financial ledgerment.
Yeah. So that's not going to last more. I mean, more than June probably, and then that's over. So one way or the other. So we have this little lull in the activity here of the bear market. You could falsely try to chase it if you want to. I'm going to carefully try to participate in it, but remember, it is short-lived, and on the other end of it, the revenge of the liquidity crisis is going to come back, and it's going to come back hard.
And that liquidity crisis, I think, has already taken place in China, and we talk about China a lot, but the dominoes are kind of falling there. They got crashing demographics, a real estate sector that is the equivalent of a Hollywood stage set. It's all it is. It's just a bunch of a backdrop, you know, it's
Kerry,
choking
Kerry,
them.
that's why I love coming on your show. You're a genius. So let's just talk a little bit more about China. So China has, for many, many years now, had a shrinking labor force growth.
Hmm.
And for the first time and since 1960s, they actually now have a shrinking population growth. Well,
Right.
that's half of GDP. The other half is productivity. So, I mean, China makes up numbers, don't you know? And they actually said, China said, the government of China said that their GDP grew by 3% last year. So they're saying that the productivity growth from locking up everybody in their houses for 2 years, the productivity of those people actually increased so much that it offset the decline in the workforce. Think about what I just said. So now, are you saying that people are much more productive, Kerry, being home than they are going to a factory? So now, when everybody's released out of their houses to travel and going back to work, then I guess that's a decline of productivity. I'm not quite sure I understand that, but more to the point where when I mentioned their debt bubble, you mentioned their real estate bubble. Their home price to income ratio dwarfs that of the United States, which is unaffordable. Homes are unaffordable here. Imagine how much more unaffordable they are in China. So going on a massive a debt and construction spree right now to build more homes and empty cities is even so stupid that the government of China wouldn't even try it.
Yeah, you would think. The home builder stocks have bounced off their lows. So maybe that is telling us something about a potential pivot. Eventually, Powell's got to succumb to the pressure. Maybe there's something else going on, another war. Who knows what's going to be? But something is going to happen here.
Well, he's eventually going to pivot, but I want to reinforce that he's not going to pivot as soon as Wall Street wants him to pivot, because a genuine pivot would be to cut interest rates and to bring them to the direction back to zero.
Mm-hmm.
If he does that now, he's going to have oil in his face go above $100 a barrel in a heartbeat. He's going to have financial conditions ease to the point where even less tight than they were when he started down this path. And he knows the credibility. They don't have any credibility with me, but any credibility they have with the American public after this big battle with inflation, he's going to have an even bigger battle with inflation. He knows this. So don't look for the Fed to capitulate just yet. They'll capitulate, but it's only going to be because of the depression that we see, only because asset prices start crashing, even worse than they were in 22. Then you'll get a capitulation. That's why it's important. That's why it's so important, Kerry, to ride these liquidity cycles, because you don't want to be on the wrong side. Like if you were leveraged long Cathie Wood in 2022, I mean, you were down about 60%, I think. At one point, you were down even more. So you tried making up. You have to be down. You have to be up more than 100% when you're down 60%. So it's a long road back. So being on the right side of the cycle, being long bond and bond proxies, defense shorts when you need to be defensive, and then getting out of that allocation and into something that can ride a genuine bull market higher, a liquidity cycle higher, is absolutely mandatory, rather than just buy and holding the 60-40 portfolio, getting charged a bunch of fees for doing absolutely nothing but ruining your retirement.
I love the way you put it. Hey, you got to go over to pentoport.com, see Michael's latest wisdom there. Very valuable. As he proved, where else but in America can you be a success when you lose 4% in a year, right? When everyone else is losing 30, 40, 60%. The genius Cathie Wood loses 60% in your portfolio. Why are people still listening to her, Michael?
Because I'll tell you why. An $8.3 trillion monetary base is just so much gambling in Wall Street. We even talk about the 1-day options now that are like, going into a casino and with no, I mean, option expires in 1 day, Kerry. those contracts, the number of those contracts has exploded because there's just too much damn money floating around, and they're gambling it on what has been the best performer so far in this early part of 2023. It's the stocks that have no earnings, and if you have no revenue, you're even doing better.
It's the GameStop economy there, you know. They're worthless basically, and there were so many stocks like that. Hey, I could keep talking to you all day, Michael, but we don't have time. Make sure you go over to pentoport.com. Hey, send us an email. Got a question for Michael, myself, anything financial, KL@kerrylutz.com. And don't forget, if you're at the website, financialsurvivalnetwork.com, make sure you sign up for your free newsletter. Michael, we'll talk to you next month, and we'll see how this circus unfolds.
Thank you, Kerry.